In financial management, you might have come across the word operating leverage. What exactly does this word mean? Let's consider two companies, Company A and Company B. By the look of it, both companies seem to be rather equal in size, with both generating sales of £800, variable costs of £500, leading to a contribution of £300 each for Company A and Company B. The only difference is the level of fixed costs. Company A has a fixed cost of £100, while Company B has a fixed cost of £200. When it comes to operating leverage and operating risk, Company B is believed to be more risky than Company A. Now, we cannot see straight away how this is the case. One way of realizing which company is riskier when it comes to operating risk is to calculate the operating leverage. Now, this ratio is calculated as contribution over operating profit. For Company A, the contribution is £300 and the operating profit is £200. So the operating leverage is calculated as 300 divided by 200, which gives an operating leverage of 1.5 times. Company B has a contribution of £300 and an operating profit of £100. So the operating leverage for Company B is calculated as 300 divided by 100, which gives us 3 times. Now, based on the figures, the company which has the higher operating leverage is Company B. However, how does that work in practice, and how do we see the downside to having higher fixed costs in a company? To be able to answer this question, we will assume that both companies experience a fall in sales of 10%. Let's analyze a fall in sales of 10% for Company A and Company B, and the result in terms of operating profit. Now, if sales falls by 10% for Company A, then what we can simply do is we can simply take 0.9 multiplied by 800, which would give us a figure of 720. And that applies to Company B as well. Variable costs, which varies directly with sales, also experiences a fall of 10%, which means 0.9 multiplied by 500, which gives us a figure of 450. And same applies to Company B, giving us a contribution of 270 for both Company A and Company B. The only difference is Company A has a fixed cost of 100, and by nature, fixed costs do not change in a business. So 270 minus fixed cost of 100 gives us an operating profit of 170. However, contribution of 270 for Company B minus fixed cost of 200 gives us an operating profit of 70. Now, we established earlier that Company B has higher operating leverage, and Company B suffers mostly from a 10% fall in sales. The reason is it still has to pay higher fixed costs. Was there another way of determining the changes to bottom line results? Let's have a look at what happened to operating profit and how we can use the operating leverage ratio to measure the impact. What is the change or percentage change in operating profit for company A? Well, think about it. Initially, the operating profit was 200. It changed to 170. So the difference is a change in operating profit of 30. The initial operating profit being 200 means a change in operating profit of 15%. However, there was a different way at arriving at this figure. Earlier, we calculated the operating leverage ratio for company A as 1.5 times. And the change in sales being 10%, all we needed to do was 1.5 times multiplied by 10%, which gives us a fall in operating profit of 15%. Let's look at how this applies to company B. Well, company's B operating profit changed from 100 to 70. So it's a change of 30 over 100 implies a change of 30%. Earlier, we calculated the operating leverage for company B as 3 times, the change in sales being 10%, and there you go. That means a change in operating profit of 30%. The key is a company who has higher fixed costs is believed to have higher operating risk and operating leverage. Those companies will suffer mostly when there is a fall in revenue.